Good afternoon, guys, and welcome to today's edition of our non-farm payroll special. My name is Alejandro Zambrano, Chief Market Analyst with TradeCaptain.com. Good, I can see that we are online. Yes, so I was saying, good, I can see we're online. Guys, thanks so much for joining me. I hope you are ready and set for today's non-farm payrolls. If you're not, I'm gonna show you guys my technique, the way I look at the markets when I look for trading ideas. And I said, of course, good afternoon to anybody that is here based in Europe, but also, of course, good morning to all of you guys in the US, and I guess good evening or good night almost for some of you guys based in Asia. We have a lot of people here: Koresh, Lance, Juan, and Ricky. Ricky. Guys, thanks so much for joining me. If you guys that are watching want to participate in the chat box, then just log into your YouTube account and you'll be able to interact with me. So let's begin. I'm just going to show you through the process of the way I analyze the markets. Now, you need to bear in mind that non-farm payrolls trading is risky because of false breakouts. What is interesting though with the non-farm payrolls is that many times you're going to have major lows or major highs in the markets when you have non-farm payrolls out. So that's interesting. And then there are also scalping opportunities. I'm going to show you a setup. Now it's not the primary way I actually trade the markets. I used to trade very short term, but I trade much more long term nowadays. The whole positions for until we reach my target many times, which means 2-3 weeks. But I guess average maybe a week or two at most. Sometimes it could even be longer. And the reason for this is just that scalping around, say, for payrolls and things like that, it's not as easy as it used to be. Uh, when I started in 2006, you would get the news, so you can watch the news on Bloomberg. They will tell you the number, and then you still have time to go back to your PC, click and buy before the market reacted. That's how slow the market was before. Now everybody has algos, so if the number is good, all big banks immediately adjust the numbers higher. If the numbers are back at lower, they just adjust them lower. And it's an algo, so it's not even a human being doing that any longer. So the opportunities are not as they used to be. Uh, okay, so let's start. As well, I didn't say it, so please bear in mind, I'm going to conduct some live technical analysis here. Uh, I'm not going to be giving you buy and sell recommendations, but I will show you what I think the market is doing. You also need to understand that trading financial markets is risky. So let's get going. So the process of the non-farm payrolls is quite straightforward. I have some screenshots here from a Bloomberg terminal. So these are the latest numbers from Bloomberg. The market anticipates that 190,000 new jobs were created, and that the unemployment rate remained at 3.9%, and that our average hourly earnings increased by 2.6%. Now, let's make it simple. The unemployment rate is very sticky. It doesn't move a lot, and it's at very, very, very low levels, 3.9%. That's very low. So if you have 100 people, 4 people have a job, don't have jobs. 96 of them have a job. So the unemployment rate is really, really low, and that tends to create higher wage growth. Why? Because you only have 4% or 4 people in the room, and if you want to hire them, they can be picky. So usually it's not even those guys you hire. You hire other people that are employed by other firms, and you need to pay them more salary. Get them to change and work for you. So that's why wage growth is really what we're focusing on today. And if this number is higher than 2.6, so maybe 2.7, 2.8, then that could really cause the dollar to soar. On the other hand, if the number is lower, so maybe 2.5, 2.4, then that could cause the market to decline. Why would that be the case? Well, because the market is anticipating the Federal Reserve to increase interest rates later on this year. Right now, the expectations for a rate hike are high, and right now the rate is at 1.5, between 1.5 and 75%. So we are here in this column, And by the end of the year, the last meeting is going to be on the 19th of December. You can see that the probability that the interest rate remains at the present level is just at 3.4%. And the likelihood that it's going to be moved up at least once is at 25.9. And then you have the likelihood of 2 rate hikes at 45.5. And then you have some people that believe that we're going to have a third rate hike this year, or a third one from the one we have right now. So if you add 23 plus 3 plus 1.9, what's that? So but this 23.3, that's 25.2. So the market is giving it a 25.2% likelihood of having 3 additional rate hikes this year. And if wage growth does not increase and goes to the downside, then this will probably be reduced. So suddenly people, will be betting on maybe just 1 or 2 rate hikes. So the dollar is actually quite fragile if the non-farm payrolls, if wage growth is not good. Now you have the headline number, but the problem with the headline number is that it's extremely volatile. It can be extremely high. It could also be extremely low. It's very random, and the reason for why it's random is that it's not just because of that, but they put seasonality filters on. So sometimes the government that produces these numbers, that government agency, they have filters, seasonality filters and things like that. So that spooks the market, but sometimes spooks the number really, making it very low, sometimes very high. But it's just difficult because this is a sample at the end of the day. It's not that they go and ask all companies, big, medium, and small and micro companies around the world or around the US, and ask them, do you hire or not hire people? This is just a sample, so it doesn't have to match with what's going on in the real world. Anyway, here, if it's below 150, that's bearish, so dollar weakness. And if it's maybe 220 or 250, then that's really good. But the number we should be watching is this one. This is the important one, because as long as this number is above 150, then the unemployment rate is going to remain unchanged. And as long as the unemployment rate remains low, then this number is going to tick up. Okay? Okay, so now you know a little bit about the background. So what we're going to do now is going to try to find some setups, and I'm just going to do the process with you so you understand the process and potentially could do this yourself without my help one day. So the first thing I'm looking for is a range bound market like this. It's relatively range bound. The only issue is though that the range is quite wide. For today the range is narrow, but for the last few days the range is quite wide. The range is about 89 pip. Now, because the overall trend is bearish, I prefer a decline, which means that if we take out this low, and this market could revisit the low, that makes perfect sense if the numbers are strong. And because we're stuck in this range, it's only if the numbers are good, most likely, that this is going to spike to the downside. So here you can look to make potentially 108, 107 pip by potentially risking this difference. Okay, this is the alternative, and it's a boost to the upside, and that's the sort of the bullish scenario. Again, not necessarily the best because of the wide range. So let's move on. Here's the pound versus the USD. This here has some sort of, you do have some sort of a low down here, and you do have some sort of resistance up here, and bearish and bullish, but this is not really sort of clear levels to work with. But obviously take out the high, and this is probably going to continue to head to the upside, and take out the low, and then probably going to head to the downside. But then the difference here is too wide, so the stop loss is not going to be good. Now here's the dollar yen. The dollar yen is already on the rise, so we don't have a range, nice narrow range to work with. Here's the Aussie dollar, and Aussie dollar as well is sort of stuck in a big range, which just makes it a bit difficult to work with. But I guess if we take out 76.06, it can go to the upside, but it's just a big problem here because we're gonna have such a wide risk. Okay, 133 pip doesn't make sense. And New Zealand dollar, this is still not really that good either. Dollar CAD, well, dollar CAD is just stuck in a big range overall, so that we won't even bother with that. Gold, let's see if we have something in gold. Nothing really in gold that I want to get involved with. This is interesting. Stock markets in general have risen, right? They have risen because of what? Well, good economic conditions. Break to 70.15 could be interesting as well. Now let me just see. I need to load the numbers. The numbers are going to be out any minute now. 40 seconds left till the non-farm payrolls are out. So we have one scenario which is for the euro. Fortunately, again, it's a bit too wide. And then we have another scenario. So you have with the Nasdaq 100, if the numbers are good, then the Nasdaq should break to the upside. Slightly better numbers than expected. Wage growth as well is better than expected. So overall, better numbers than expected. Overall, better numbers than expected. Okay, wage growth 2.7, so slightly better. Non-farm payrolls 223. So the euro should most likely potentially be able to drift lower, take out that low, potentially move to the downside. I would guess the dollar yen and things like that have already moved higher. Let's load the Nasdaq. So the Nasdaq here is pulling back a little bit. I guess what the market is worried about is that inflation is just going to cause the Fed to increase interest rate faster than what they're currently projecting. But what's going to dominate here? I think the bullish trend overall, and I think if this goes to the upside, it should be fine. Here, the euro is probably going to try to stick out the low. The euro is bearish to begin with anyway, so hopefully take out the low and just drift slower. Walt just joined us as well. Let me know, guys, if you have any questions. Let's see how the market reacted. So this is the euro to your left, the pound trending sideways for now. Let's take a look at the dollar yen. Dollar yen is moving to the upside. Tricky situation, but solid numbers. There's no real reason why we should be not assuming that this can't head to the upside. Aussie dollar trending sideways. New Zealand dollar, it just took out support, but unless all these other markets starts declining, I wouldn't be betting on this to move to the downside. Crude oil lower. Difficult though to interpret the effect here, just because obviously we're dealing with the dollar. The dollar strengthens, crude oil sometimes weakens, but at the same time, there's a lot of people having jobs in the US. They will most likely be able to use their car more often, maybe even buy bigger cars. Gold should definitely be moving to the downside. So here, at this stage, it's just a little bit too late to jump on board. We did talk about gold in the morning update, but that's an idea that was based on that was not based on the known from payrolls. In the morning update we host here, I said um, already on May, in the beginning of May, that if we take out this level, the market should head to the downside, and the stop loss was up here. We'll reduce it once, and then a third time. And here the market is obviously capped by this level. So this would have been something would have shorted already here 15 days ago, or on this pullback here. I got a question here from Ricky Rick. Can we start buying dollars and selling gold, or should we wait? So in the case of gold, the risk every time when you trade, the risk-reward ratio needs to be good. And while I think this is probably gonna work out, then I think it's gonna go down. The risk-reward ratio is not necessarily optimal. I mean, actually, it depends on how you look at it. It is possible to have a short right now. You risk about $18, and then the market goes down to the lows here, maybe a few weeks. So 21, say 22 divided by, I think it was $17. Yeah, say $18. That is a risk-reward ratio 1.22. So you're looking to make slightly more than what you were risking, but it's not sort of the ideal position. It's not the ideal entry. In the case of gold, you should have shorted here at 1,300. And sort of the best thing you can do here, Ricky, is in essence is that you just join us here in the morning updates, because every Monday to Friday I take a look at Eurodollar, I take a look at Bitcoin, I take a look at crude oil, DAX, and so crude oil, gold, Bitcoin, Euro, and the DAX. So 5 different markets. So shorting gold was something I communicated over the last technically a whole month. So let's take a look at those indices. So the indices are not really moving too much. They're not really moving too much, and I think it has to do with the fact that the market probably is sort of getting worried about rate hikes. And it needs to sort of weigh pros and cons back and forward. But I think at the end of the day, I mean, the Nasdaq, you can't really, I wouldn't be buying now, but if the Nasdaq goes to the upside, then that could make sense. My original idea with the Nasdaq was just to buy here. So some of my clients are long here, pushing, and I don't know if they kept them or not, but I think if we take out the high, we can go to the upside. And I am personally long the Russell 2000. So this is the Russell 2000, and I bought a 1636. Why? Because the Russell 2000 first had a break above this longer term pattern. Second, because this is an extremely bullish day, and this one sort of confirmed the bullish bias. So what I did here is that when everybody was crying about Italy and losing money, this moved to the upside, and that tells you something powerful. So I just took a fib from the low to the high. The market moved to the downside, and I just had an entry because I was using the first Fibonacci level and that first high. I'm in a bit of profit, of course. Doesn't have to work out, but I'm quite confident that as long as you trade above 1606, that this market should be able to trade to the upside. And there are different ways of calculating a profit, but this is a high, this is a low. So some people will take the base, some people take the middle. The middle seems to be a sort of a good middle ground. And from this high to sort of this low is $169 or points. So 129, sorry. So 129, let me see here. 132, say 130. 130 takes you up here to 1750, more or less. So that's hopefully will move towards that level. It's a very aggressive target because it implies a 8% rally. Not sure I'm gonna keep it all the way up to that level. From a risk reward ratio perspective, I'm risking 30. So if I can make 60, so just go up here, that would be good. And I might try to, we'll see what happens, but if I can try to push it a little bit higher or a little bit more, then that will be even better. Let's go back and take a look at the euro. So euro is still just trading sideways. So it's trading sideways, right? So we don't have a trade on here. Need to break 116.38. The data and the technicals needs to agree. On the other hand, if we take out this level here, if we go to the upside, then again the technicals and the fundamentals are not agreeing. So we don't have a trade idea there if that happens. It might be that we have a larger reversal at the time, but again it would conflict directly with this strategy. Okay, do you guys have any more questions? As we wait for the markets to make their first move, it's always good to let the market make it move. Do any of you guys trade the cryptocurrencies? People absolutely, I still think people love them, but there's a lot of people that don't, for obvious reasons. But it's a good little, it's a good market, just because the way it trends, when you have a breakout, those reward ratios you get are just amazing. But that's primarily on the long side usually. You can of course sell. The problem though is that a market can only drop with 100%, right? Whereas when they rally, they just rally like crazy. So this is something you want to keep an eye on. I know that less and less people are talking about them. Why? Because we're back at the low. It's just a lot of pressure, a lot of crying, a lot of pain. But it's sort of when these situations, when the market has calmed down, when there's not much happening, that it makes sense to revisit these markets. Just use your technical analysis and you'll be good. With Amana Capital as well, you can now trade Bitcoin, Ethereum, Litecoin, and Ripple. So Ripple is something I'm watching right now. Ripple is technically still bearish, and could be really interesting. If we take out 69, 20, 92, the risk will be 15%. So 15% is quite a lot. So as you probably guess, I don't trade with leverage. So I will usually take 25, 40% of my capital. Sort of depends what's going on. Because if I have a 15% stop loss and I just put half of my capital, then my effective risk on the portfolio is 7.5. Again, some people think it's a lot, but it's all about those risk reward ratios. So let me explain. So we risk 15 here, and if the market indeed bottoms out, we should be able to maybe push a little bit higher. So maybe make 24, and if the market bottoms out, maybe 39. So 39, or let's make it simple, 40 divided by 15, that's 2.6 times. So I might be risking, say, 7.5 if I buy 50% of my portfolio, but if it plays out fine, I'll make 19. So this is something that cryptos offers nowadays. The possibility to have just amazing risk-reward ratios. Here's Ripple, by the way, in by the end of last year in December. Ripple was just utterly boring. In May, had that big push, and then in May, sort of turned boring for half a year, and then you had that break. It was at 28 cents. So long here, stop on the other side. 32% risk. $1,000 return divided by 32. That's 31 times your money. So $1,000 here would have generated 31,000 in return. That is, of course, if you would have actually exited at the high. I mean, what is interesting is that you have these people that really love this, and maybe they were kept it all the way up because they believe and love it so much, so they trust it. Alright? But what is interesting is because they love it so much, when it went down, I'm quite certain they were like, what's going on here? I'm just lost a huge amount of money, but I love it so much, so I'm gonna keep it. And then probably went down a bit. I don't know too much. I mean, I know quite a bit, but I don't know too much. And I don't necessarily love cryptos. I trade cryptos, but I bought down here, more or less. Bought down here, and then I bought a little bit more here, and then I got out around here. Dollar looks to turn around. Tempted. Why isn't the dollar pushing upwards? I guess, and let's take a look at the markets. I mean, if you look at the euro, there's a bit of a fatigue in the market. It's a little bit of the market starting to get a little bit tired of dollar gains. And sometimes big players, they use these events to liquidate positions because they know now that a lot of people want to buy dollars, so they sell their dollars at the same time. But I think it's just fatigue. I think this whole market is going down for a very long time, the euro, and technically we're still bearish below 1750. This is a slightly longer term analysis that is not based on the note from Payrolls. And then you have the pound as well, which technically still is bearish. But then you have Aussie dollar, which is trading sideways. You have the New Zealand dollar, which as well has even a bit of a bullish bias to it. And then you have the dollar CAD. So you have 3 out of the top coins being neutral against the dollar. And then you even have the only sort of really bearish market or pro-dollar market right now is the euro, which is bearish, and the pound that is bearish. But even the euro is sort of struggling. So I think what's happening here is that just the market is just getting fatigued. It's just getting tired. I think people know that, it's probably a good idea to look to book a bit of profit, and I think that's limiting price. Lower dollar should stimulate stocks. Yeah, to some extent. There's definitely a very, very tight correlation. Say when the euro dollar gains, you can clearly see how the DAX suffers. Why? Because the DAX 30 just makes up of big companies that are very good at exporting, right? So that's really good for them. Also, when the euro weakens, it's really good. When the euro strengthens, it's bad. For the US, it's a bit mixed. US stock markets in general, because they don't have that dependency on export. And there are other benefits as well. With the dollar gaining, you keep inflation at bay at home. So the dollar gains, that lowers the prices of imports, and that helps as well. But sort of the that strong correlation, negative correlation, is very evident. Say DAX and say the FTSE. When pound gains, the FTSE loses, and vice versa. Okay, we're gonna wrap things up. I want to thank you so much for joining me, guys. You just need to wait patiently. Half of the time is just waiting, and then you're in a position and you wait some more. Um, it's fortunately like this. Okay, guys, thanks so much for joining me, and feel free to join me here on Monday for yet another update, as we usually do here Monday to Friday in the live training room. Thank you, guys.